Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable where we talk about current market conditions, what to expect in December, and what to expect next year in terms of the market and which themes work, which kind of lagging. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Always want to welcome new subscribers. This is my brief bio. I was Executive Vice President, Head of Technology at Options Express from its inception through 2007. Options Express was an online broker-dealer acquired by Charles Schwab. I've been managing my own money for over 20 years. I have a master's degree in computer science and specializing in artificial intelligence, neural network statistics, AI. So very passionate about models and financial engineering, AI, and been managing my own money for over 25 years. So that's my background. Disclosures are very important. I encourage you to read them. If you need to trade in stock or options, please visit optionsscreening.com so you understand the risk associated with trading stock or options. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. All right, let's take a look at the market. So let's look at Tradespoon. Some of the tools. So first, again, neural network. This is Stock Forecast Toolbox, one of our main models. Basically, it says 457 is your overhead resistance on spiders, 451 is your support. Model does turn negative, basically showing in the next 10 days. Potentially, we can revisit 444 level. I agree with the model. I think market is overbought and due for a pullback. Model has been bearish for the past 2 weeks or so. Market hasn't really gone anywhere in the past 2 weeks. But I mean, we are trading on the key support, right? S&P. I mean, the QQQ is sitting on the support level since November 13, right? So for the past 2 weeks, not going anywhere. And it's a key support. If we do break below this level, right? If we do break below the current level or 384, I think then we can quickly drop to 376, 380. I think this level will hold towards the end of the year. So maybe 4%, 5% pullback. I still think it's going to be shallow, quick pullback. Maybe a couple of weeks for the next 2 weeks, just like the model says. And then still, unless there is new information in the market, still Christmas rally, right? I assume that Powell is not going to say anything new, right? He's going to confirm into this theme of that. Well, actually, I think he needs to change his rhetoric. Actually, a lot of people think he will. So that's the assumption. So he needs to change his rhetoric to basically confirm what's been said this week, that interest rates, that inflation is subsiding significantly, and that they're gonna, not gonna raise interest rates, and potentially, consider lowering interest rates the first half. That's what market assumes. I think there's a 100% assumption, 100% probability based on Treasury futures data, right? That by June, there will be 100% probability that the Fed will lower at least by 25 basis points by June. That's what everybody assumes. Powell needs to confirm that, right? He's going to speak, I think, on December 12th and 13th. So in 2 weeks, next Friday, we're going to have unemployment data, and then we're going to have a CPI and PPI data, right? Assuming that CPI and PPI data and inflation and unemployment data confirms to the notion that inflation is subsiding without causing recession or jump in unemployment, right? And Powell says something that basically confirms to this notion that we're not raising interest rates and we're not going to have higher for longer. I think my core scenario is that eventually we retest, right? We drop below 450. For now, 450 is the main support. We haven't really gone anywhere from that, and then we do have Christmas rally, right? And potentially just closing somewhere between 460, 440. So I think this level will hold. I don't think Powell is going to say anything really negative, especially during December, during Christmas time. So that's my core scenario. The risk, if that says that, listen, we think we potentially can still raise interest rates, then you have this reversal of this unwinding of this whole trade, right? Which could probably get you to at least, 50-day moving average, right? So that's probably worst case scenario going into December. I think consensus, because of the seasonality, if you look at our seasonality tools, that's probably the main reason for this opinion, and a lot of people have this opinion, is that usually first 2 weeks of December there is a pullback. Doesn't have to be, right? Correlation is growing, right? We were very high correlation going into August, September, October. Then there was a divergence because the drop would continue, even though usually it starts rallying. And now correlation is going back up from 20, 30, 40, 50%. If we do have this 2 weeks pullback, then we'll get close to probably 70% correlation. So assuming that there's no kind of surprises, then I think this is the price action, right? We drop 2, 3, 4%, and then we rally 2, 3, 4%. That's the consensus. Market hasn't, as I said, hasn't really gone anywhere. We do have a pretty strong move. I mean, the pullback would be even stronger. The only thing that's kind of holding the market is DIA, right? Dow Jones is at, I think, close to 52-week high, right? Close to January. I don't know if this is correct chart. I think, let's do bar chart. They're having some issues at longer dated, but let's just confirm this DIA. Five years. Yeah, the top is around 366. So we're approaching 366. This doesn't say 366. So yeah, for some reason it's off. It's missing some data. I should report this. But anyway, right, so we are approaching on DIA, we broke through year-to-date high, right? We broke to year-to-date high, and we're not that far from the all-time high, 368. Any questions? So that's short term, but then long term, right? Where are we going long term, right? On S&P 500 stocks, right? Let's talk about first half, right? So let's assume there's no surprises this year. What's happening first half of the year, right? That's where the opinions diverge by significantly, right? By a lot, right? There are a lot of people say that at least 10%, 10 to 15% higher in the next 6 to 12 months, right? So that will take us to 500 level, right? To 500. Breaking through all-time high, which is 480. All right, this is wrong, 480. So scenario number one, from here, we're going to 500, right? Up 10%, right? Bullish market. Basically, it confirms the notion that interest rates are going down, high yield is going up, Bitcoin is going up, so risk on, right? And we don't have recession, and unemployment is very resilient, and inflation is continuing going higher, lower. Inflation is continuing lower, and companies are going to start reaccelerating their revenue growth. So that's scenario number one going into for the next 6 months, right? Going into May, end of May. The other scenario is that soft landing, right? That ultimately what is the reason for this inflation dropping across the globe, right? We had CPI data from Europe yesterday, from Eurozone, and it dropped significantly in France and Germany and Britain. So I assume we're going to have pretty good CPI, pretty low CPI and PPI reading in December as well. So then the question becomes, what's the reason for that? Is that because environment is restrictive enough, but demand is continuing to stay strong, or is it or is the economy slowing down across the globe significantly more than previously anticipated, right? So if that is the case, if the macroeconomic data starts showing up that we actually have deceleration in Q4, and that deceleration is going to continue to Q1, then we're basically trading in the range for the next 6 months, right? We're back to this range, right? People are going to start talking about mild recession or deceleration of earnings. Then you're going to have scenario number 2, right, where we're retesting. Well, that's October lows, which is so at least 4,200, right? At least 4,200, but potentially somewhere in here, right? Somewhere in here, right? Maybe 380, maybe 400, maybe 360, but somewhere in that region, right? We're testing either the October lows of this year or October lows of last year, just depending on severity of this data, right? That's scenario number 2, and scenario number 3, we're breaking through 340. I mean the October lows, 3. So scenario number 1, scenario number 2. So that's where the world divides, right? If you listen to Goldman Sachs, they're basically saying up, up and away, 500, right? JP Morgan, you hear that's Goldman Sachs opinion. Right? Morgan Stanley's, somewhere in here. I'm not sure who's calling for break of October low. Very few people. Very few people. At least institutional research. Institutional research, you're not going to find a lot of names here. So how many of you say 1 up, up and away, right? You say Goldman Sachs, JP Morgan knows a lot better than I do, and we're going to, higher highs. How many of you say Morgan Stanley, has been a little bit off 2023, but they'll be more accurate in 24, right? And then how many of you say, recession is going to be deeper? It's not going to be a small, mild recession. It's going to be prolonged recession or prolonged inflation, right? If inflation goes back up because, let's say, Fed lowers interest rates in March, like everybody anticipates, and all of a sudden inflation goes back higher, like in 70s and 80s, then Fed has to start raising interest rates again, right? So either inflation is going higher or recession is going higher, right? And you have scenario number 3. All right, so that's a little bit more debatable. That's where the opinions diverge, right? So how many of you say 1, up, up and away, bullish? 2, no, we're still trading sideways, and 3, we're actually going to have recession steeper than most people anticipate. All right, Martin, 1, up, up and away. 2, sideways. 1, too much money on the sidelines. Mark, you appear as Mark now. All right, love it. Not as a trader. Sir Mark is back. Okay, Mark was actually very accurate in 22. Right? I actually said 3. Mark said 1, and Mark was correct. Too much money on the sidelines. I like it. All right, we have a couple 1s. We have 2. Anyone else? BJ, Don, Felix, Henry, Joseph, Mark, Martin, Michael, Patrick, Tom, Mark, Steve, Jonathan, HIWayMN. Anyone else? All right, I'm going to disagree with Mark again. I'm going to put 2. So my vote goes for the next 6 months. I think this rally is a little bit too fast, too far, right? This rally kind of was similar, right? But we had a pullback in March, and I did say we're not going to break 430, but we did, or 430, right? We did because of the AI, right? So assuming there's no some kind of AI 2.0, right? Assuming that there's no AI 2.0, it's the same kind of thought process as last year. Last year we were ending up, on a negative note, right? So Mark was correct. Too much money on the sidelines. Market was oversold, and because there was no recession, which everybody anticipated, Mark was, in retrospect, yes. In hindsight, extreme accurate, because we did have a huge run, and a lot of people did call for that. This year, I don't think we're going to break through this level, right? I think this is the worst case scenario. I think, but 380, or some revisit break. I think we're going to break through the August, October lows and reach this level, right? Sometime between now and June of this year. Why? Well, because this rally, the only assumption is the Fed is going to lower interest rate. So everything depends on interest rates. If Powell is going to say that we're not lowering interest rates and we're still not achieving the target goal of 2%, or he's going to say we are achieving the target 2% goal, but economy is slowing down so much that we have to lower interest rate because of the recession, right? In both cases, which I think are more likely than this immaculate disinflation and money being on the sidelines, I think market is prone for a pullback. When is it going to start? I'm not going to guess. I mean, I'm going to give myself more, like before I said, first quarter, kind of learn. One thing that I did learn in retrospect, just trade what you see, right? Not what you think, right? So suggestion is that we do have the highs, and this is not right, a little bit higher, right? So first we need to break May and August high, and then we need to break through, it should be like this, and then 480, right? But as long as we're not making new highs, right? Then the path of least resistance is to the downside. If we do see a breakout above 480, if we do see a breakout above 480, then I'm wrong again, right? And up on the way. But until then, I would watch this level. More importantly, I would watch. I mean, high yield, right? High yield is continue to being strong, going back to almost 2021 high. Right, and that also is, I don't know, is it, need to fix this, because I'm not sure if I can trust this. Let's see, 5-year. Yeah, this is not right. HYG was 90 back in January of 22. It was 90, not 80. Okay, so I got to figure something out. But okay. So HYG still kind of in the bearish market, right? Because we were at 90 and 75, we're still almost 20% lower. So, and the rebound is still kind of unimpressive. So high yield is one, and then small cap stocks, right? Right, and small cap stocks, let's look at 5 years. Also very weak rebound, right? All, we were at 240, we are at 180, more still in bear market. So as long as the small caps are below 200, and that's probably more popular opinion, the bulls assume that small caps will break above 200 level. If they do, then I would have to turn around and say, listen, okay, then, Powell is actually, we do have immaculate disinflation. But small caps, for me to change my mind, we have to break above 200 level. As long as we're below 200 level, then something is wrong. So small caps and HYG. I mean, can we still have these rallies on Magnificent Seven because of the AI? I mean, maybe, right? But that would be just, again, a very small selective number of stocks. But as long as HYG, right, is struggling to break through this level, right, as long as HYG is struggling to break through this level, then that's an issue, right, in small caps. That would be my opinion. Also, dollar, right, like Goldman Sachs was very weird. They said they anticipate that, that the market is going to reach all-time, break through all-time highs, but they also anticipate that the dollar is going to continue to be strong this year, right? We're still up for the year, right? We're up for the year, not a lot, but up. So, break through this level. That doesn't make sense to me, right? If the dollar is going to be stronger because that means that there will be a headwind to the earnings, and economy is not gonna, the market is not going to continue going higher. So I assume that dollar will rebound, right? And I do assume that 10-year yield either going to rebound because inflation is still higher for longer, or we're going to start seeing signs of recession, and then the market, and then the Fed will be forced to lower interest rate. But unless there is a recession, I don't think Fed will lower interest rates, right? So that's not what the market assumes right now. So that's kind of my thought process going into the next year. Small caps are very strong today. Yes, small caps are very strong today, but they're still failing to break through $200-day moving average, right? So they are stronger today. They're up 1%, but you can see QQQs are rolling over. I mean, there is an idea that this year, because the interest rates are going to go lower and inflation, that there'll be a major rotation, right, from Magnificent Seven back into value stocks or small cap stocks. Maybe this was the same call as last year. It never worked out, right? Technology considerably outperformed, but that was a popular opinion, along with the energy, right? This is going to be the year of energy. So people who called for energy to be higher were wrong. People who said that Fed will lower interest rates this year were wrong. And the only reason they were right is because of the AI, not because money was sitting on the sideline, but purely because of this push for AI, right? If we don't have a push for AI and we don't have recession, I just can't think that Fed will lower interest rate. The unknown is obviously elections, right? It is a year of elections. Usually during elections, first 6 months is also volatile, and Fed, might be in a, this is more of a politics, might be in a situation where they don't want to lower interest rates before the elections, right, in September, October. So they kind of forced to lower the first 6 months so people don't judge them that they are accommodating the, current government, right? So I've seen that opinion. I don't know how accurate that is, but if it is accurate and Fed will lower interest rates just to kind of please the, because of the political issue underneath the hood, and then the inflation does come back, right? Inflation does come back. Well, I think that's even worse, right? Then we're back to, initially market can rally, right? Market can rally, but if inflation comes back, then it's kind of a false breakout and it can roll over. All right, so how do we help on TradeSpoon, right? So this is an opinion, right? Long, short term. Bottom line, nobody knows, right? That's one thing that I've learned last year, that even if people were right that the market is going to be higher, it was higher for a completely different reason that they thought is going to be higher, right? Because people who called market to rally this year basically said that interest rates will go down. Nobody anticipated that interest rates are going to jump to 5%, right? That was not their call. So they were lucky, more of an element of luck than element of being able to predict, the future. So I'm a little bit more humble this year than I am last year. I'm going to say that, I reserve the right to change my mind, and I'm going to do it on small caps, right, and high yield. If I see IWM breaking through 200 level, that's probably the sign that, I need to get more bullish on the market. All right, that's enough of kind of theory. How do we help at TradeSpoon? Elite Circle, right? So we have two types of membership. We have membership where you can follow my trades via SMS message or email, right? Every time I trade, you get an email and SMS message. So that's one type of trading, right? If you want that, then I would suggest with Elite Circle. You get access to morning bell and closing bell, first hour and last hour of trading session. That's where most of the trades occur. Usually people don't trade during lunchtime or between. Most active people are the first hour and the last hour. So I would suggest, participating in morning bell and closing bell, and you can view the recordings. You can enter your phone and get SMS messages. I believe in education. I believe trading is a skill, right? And you need to acquire it through participation, right? A lot of people want to be successful in trading, basically get signals, invest money, and they think long-term they can be successful. Unfortunately, I don't believe in that, right? Unfortunately, a lot of people say that, right? That's what they want, but then if they don't have time, right? I don't think it needs to be a full-time job, but at least half an hour to an hour a day you need to dedicate to trading, right? If you don't have half an hour dedicated to trading, then you probably want to give money to someone else, let them manage it, right? Let them manage it. But if you do have half an hour to an hour a day, then I encourage you to spend that half an hour a day or 1 hour a day, either participate in live, either in morning bell or in closing bell or in both, but that's more than an hour a day. Most people don't have it, but at least watch the recordings. If you spend 30 minutes a day, watch the recordings of live trading room, and you look at how I trade, you utilize the same tools, and just keep a journal. Journal where you record every you trade, why you get into this trade, and you grade yourself, right? I would claim that you do this for the next 90 days. I strongly believe that if you spend half an hour a day, watch the recordings, right? Follow these SMS messages and learning how I'm trading and try to repeat the same process, your performance is going to significantly improve, right? And I strongly believe that. A lot more than you're paying for your monthly membership, significantly more. Whether you have $5,000 account or $500,000 account. So that would be my challenge to you. Try it for 90 days, spend half an hour a day, watch the recording, and in 90 days, let me know if you improved and the monthly subscription was worth it. If not, we'll be more than happy to give you the money back, right? But I believe, I've never got that email before. If you don't spend half an hour a day, if you just get SMS messages, and sometimes you spend, your trade, you spend, risk for, 1% of your account, sometimes you risk 20% of your account, well, then yes, then it's a random system, right? But if you consistently watch the recordings and you consistently risking the same amount by learning how I do it, you will be, your performance is going to significantly improve. So what kind of SMS messages, what will you see during these recordings? You see the actual trades, right? So I try to do both. I try to do stock trades or ETF trades and option trades. So you do have combination of both. Some people like to do stock only, some people like to do option only, some people like to do both, right? So I try to give an example of both. So these are some of the trades. So silver spread trade, right? I have a silver spread trade. I did Marvel, option spread trades, iron condor. I did TLT option. So, and every time the order gets filled, you get a notification, right? You get notification. So I think this is a great system to learn how to trade and consistently produce better results that you had in the past 90 days, right? If you spend 6 months, you will continue to improve. So that would be my proposal. If you already have a system, right? If you already have a process trading plan, which you trust, and you've been doing this long enough where you always risk the same amount of money, you always have the same trades, you just need signals, right? You need to have views on macro and microeconomics, right? Top to bottom approach, and you want my opinion, then you can do tools membership, right? You get weekly blog, you have weekly videos where I showed you where I think the market is heading and why, right? Interest rates, equity, currencies, different asset classes, and I do give you the models that I'm using to trade also, right? So you can go to active trader, right, and basically say, okay, model is bullish on Verizon, Vlad is bullish on Verizon, and you have suggested entry exit points. You might say, I'm going to do this, I'm going to hold this stock for a couple hours. You might want to hold it for a couple weeks, but you know what you're doing, right? You just need output of the models, right? And the models will tell you, Verizon, STX, UNH, these are the stocks that are trading in uptrend. And every day, you have history, you have a lot of signals. You cannot trade all of these signals, right? Some people try to trade all signals. This is not the intention. People might not have exposure to telecommunication, and maybe they want to get into Verizon. But if you're already in Verizon, you probably don't want to add to Verizon, right? So you have to make your own decision based on your own experience. We do provide, entry one, entry. So we do encourage you to use dollar cost average, not to have more than 4 positions, right? If you expand the nodes, I do propose not to have no more than 4 positions with maximum exposure of 2.5% of account value per position. You use dollar cost average, so it turns out to be 1%. And then if you're asking question, what if Verizon, you said 37.78 and it's 38.44, it never got to any of your entry points, what do I do? If you ask that question, I propose to start with a lead circle, because that's where I actually trade these signals, and you will see the thought process why I pick one stock versus the other, and and how to trade them. So that's active trader, right? You get 3 new trade ideas a day, both bullish and bearish. In same manner, we have weekly trader if you're holding position for weeks, and monthly trader if you're holding for a month, right? Monthly trader, this Sunday was published, and Micron, right? So it gives you suggested entry prices, right? 74.96, 76.87, and then you can decide, at what point do you enter Micron. So that's active trader, weekly trader, monthly trader, right? We talked about stock forecast toolbox. I think it's very accurate, right? This week, what did I trade? I think Macy's, right? And the model was spot on in terms of, what did I do? Right, so I did Macy's trade, right? So bought it at 1571 and closed it at 1582. And the model was spot on. It's actually at 1624 now. But for that day, it predicted 1591, and it, Macy's was exactly at 1591. Right? And it continues to rally, but yesterday it was exactly at 1591. And you can see today it continues follow, through. So that would be the examples of some of the tools, right? And stock forecast toolbox is great because it gives you, it tells you basically if spiders drop to 451, you should consider going long. If it drops to 450, if it goes up to 457, you probably want to sell, right? And this is a difference of almost 1 or 2%. So even if you don't do day trading, but you considering, let's say, getting into spiders, if it's at 456, you probably overpaying, right? At least consider buying at 451, 452. If you can save 0.5% or 1% on entry and exit, your results, in 90 days or 30 days, you will see a huge improvement in your overall results. Seasonality, right? I went over seasonality chart. We have traditional indicators like Fisher transform shows that the market is toppish. MACD looks like that the market toppish, but these are all traditional technical indicators. You can look at seasonality also showing that potentially pullback. So that's another tool that we have. We have probability calculator, right? Kind of traditional tools. That basically tells you where the spiders, right, support and resistance are, right? It can drop 1 standard deviation, it can drop to 442 or 469, right? So both outcomes are possible, right? Both outcomes are possible, depends on interest rate decision, right? And we'll give you, the output of our models, right? But right now, models basically shows that it's overdone and it should pull back. All right, so we talked about seasonality, we talked about stock forecast toolbox, charts. We do have newsletters, so we do have free content. A lot of, I believe education should be free. So there's a lot of, if you want to learn about any topics in trading, right, you can go to Learning Center, right, and look at the recordings of technical analysis, advanced options basics. You'll see a lot of webinars. trading guides, and we do have newsletter with my opinion. So we have videos and newsletter where you can actually watch the, every week it will give you my take on the market, which just that alone usually costs hundreds of dollars a month. And I hope you take this free content, seriously. All right. Kevin just jumped on. Kevin, welcome back. How's OPEC Plus additional $1 million, additional cut of 1 million barrels yesterday, right? They met remotely finally. How will it impact the market? Well, there's definitely more, less supply. They're cutting the rates, they're cutting the supplies and staying lower. But you can see so far, very bearish price pattern. We are below the 200-day moving average. We're below 50-day moving average, and we've been trading in this box. So on one hand, it is oversold, right? Oil is extremely oversold. There's some seasonality, right? Usually oil is done, but not enough to justify such a big drop, right? From 95 to 72. So again, if you're on spiders, if you said we're going to all-time highs, right? Then you believe that, Europe is not in recession, and you believe that China is going to reopen and, reaccelerate its growth. It didn't work out. Right, everybody, that was the most popular call, that this is going to be the year of China. Everybody said that this is going to be the year of energy. It didn't work out last year. Well, maybe it's going to work out this year. If that's the case, if you start seeing that China is accelerating its growth and their, oversupply of real estate is behind them, and they expand, then energy is probably going to expand, right, and break above, right, and continue going higher. If you see the other way, the signs that recession, that the reason the CPI in Eurozone dropped significantly is because Germany is probably going to have a negative GDP this, next couple of quarters. Well, then the oil is going this way. Right? At some point, it's going to break out of this. On one hand, it's oversold, less supply, it should rally. But on the other hand, you see signs that there is demand destruction across the globe, and this is, again, this fits better into bearish case, because if if you can't have oil going to, continue to go lower 60, 50 when the supply is being cut and demand is also high. That also doesn't make sense. So, I mean, my opinion, that I would stay away from oil. My opinion, you sell on rallies. If it gets to 50-day moving average or here, great, but I think it's going to be a pattern of lower highs, right? I think it's still going to be a pattern of lower highs. Thank you, Kevin, for your questions. Even this one, Kevin. Yeah, Elon Musk is, not afraid to use his words, and he says what he thinks, which is not always the best idea. Talking, you might be able to see northern line. There's case. Thank you, Kevin. About Chicago weather, Tesla is finally rebounding since 10:55. Tesla is back on. I wasn't paying attention to Tesla. I mean, I see Google, right? So in terms of, since we're on this topic, so you can see that Tesla is, unable to break this level, and it's pretty, it's below 50-day moving average. Let's look at. So Tesla is kind of rolling over. Meta, you can see approaching 50-day moving average. You see Google below 50-day moving average, and now you see Microsoft starting to roll over. Amazon is already rolling over. No, Amazon not rolling over, but trading sideways. And how's the Nvidia? So this Magnificent Seven are definitely underperforming, right? Nvidia also approaching 50-day moving average. So Magnificent Seven are already rolling over. Then the question is, okay, how long will this divergence last where Dow Jones continues to go higher, but the rest of the market, but the Magnificent Seven going low. I don't think it's going to last that long, right? A lot of it depends, again, on interest in dollar, and I think dollar is building the bottom and probably will rally, and then 10-year yield is also building the bottom, right, and probably will rally, at least in the next 2 weeks. Yeah, additional cuts is because global economy is slowing down, right? Then they want to keep prices stable, right? If they don't cut, then the prices will continue to go lower. Never refills. So, I mean, reserves, I don't think refilling reserves will move the price of oil that much. Short term, it does, but it doesn't make a difference. I mean, 1 million barrels a day is a big deal, but again, the articles that I was reading is that, well, you have to assume that everybody is going to comply, right? And African countries and Russia are notorious for not complying with these cuts. So I think initial reaction, we had a rally in crude oil to 80 on the announcement, and then it gave up basically all of its gains. Because A, people are doubting the compliance, and B, people doubt that the economy is going to expand, right? Any other questions? Why would the dollar rally? Main reason for the dollar to rally, I think, short term, because it's oversold, right? The regression, reversion to mean, right? The reversion to mean, dollar is oversold, so it should bounce. The unknowns are interest rates in Europe and in the United States, right? The differential, right? If there is a perception that interest rates will be cut faster in the United States than in Europe, then it might be a carry trade where dollar is gonna actually pull back. If the Europe ECB comes out, because the inflation did drop significantly, they need to change their rhetoric, right? So if they change their rhetoric and they're actually going to start cutting rates before United States and faster, right? Then you could have bigger demand for euros and dollar will sell off. So Goldman Sachs' opinion that dollar can be stronger because U.S. economy is going to be stronger and will outperform the rest of the world. So by nature, people will want more dollar demand. I don't personally buy into that story. So I don't think that's the case. To me, what I've seen in the past 2 years is the monetary policy, right? Easing of financial conditions that drives the interest rates, that drives the dollar, and this carry trade, right? Who cuts interest rates or who keeps them stronger, right? The reason Japan, Japanese dollar is outperforming the US dollar, or the other way around. Right, because they're artificially keeping their rates, lower, right? So you have this huge rally in Japan, in US dollars, and Japan is weak, right? Because you're manipulating the interest rates. So that could be, right? So that's more important, right? That's the reason US dollar is so much stronger than the Japanese yen. And a lot of people basically say that it might pull back, and looks like it's already starting to pull back. So that carry trade can influence dollar more so than, so that's the unknown. But from technical perspective, it is oversold. It's not building, it's not breaking down. So the question is it going to rebound? Right? And what is the ECB decision and what is the Fed decision, right? So I mean, I expect December to be volatile. I expect December to be volatile. A lot more volatile than the past 2 weeks, right? The past 2 weeks. All right. Right, if interest rates are peaked, right? A lot of people basically said interest rates lower highs, right? I actually also believe it's going to be lower lows and lower highs, but there are still a lot of people think that inflation is not going anywhere, right? And then Fed will be forced to actually raise interest rates next year, right? So that's still an opinion, and it actually they were correct. The minority of the people were correct in 23. I think the minority of people could be correct in 24, right? They could be correct. I mean, granted, inflation has dropped significantly in the past year, but then this year-over-year comparison and getting core CPI to 2% might be an issue, right? Might be an issue. And the only way to determine this is to get macroeconomic data. So it's, and you know, predicting macroeconomic data, you know, it's challenging. It's challenging. All right. Anyone else? Okay, we got a lot more people now. Okay. I know some of you came later. Ted, welcome back. Any questions I can answer? It's 10:18. Not sure when everyone came, at what point. So what else? So for now, very resilient, right? I would watch this level on QQQ. Right? I mean, you can be a bear or you can be a bull. It doesn't matter as long as QQQ staying above this 2-week support, right? 384. You know, it's higher highs, higher lows. I mean, it's been stolen for 2 weeks. So a lot of people do call for pullback, including myself, but you know, we need to break through this level first. A lot of the mega cap technology stock like Google and you know, you already see, and Tesla, you already see these breakdowns, and Nvidia. You know, so QQQ as a group can probably will follow. Usually it does follow the mega cap. So I would not be surprised if we do get to 375. Right, that would not be surprised if we do get into December. I would use it as an opportunity to go long, right? Unless Powell says something, you know. Do expect volatility even today, right? I believe this is still a case, but at 10 a.m., Powell already starts speaking, okay? So we need to look at Powell's speech and kind of dissect Powell's speech. Let's see, Powell. Speech today. A lot of people search for it. Powell is scheduled to speak Friday at 11 a.m. Eastern. So he already starts speaking. Fed Jerome, let's talk. Powell keeps rate hikes on the table despite cooling inflation. Federal Reserve Chair on Friday said that while the recent bank has made significant progress on bringing inflation down to 2%, we are prepared to tighten policy further if it becomes appropriate. So Powell said in speech, blah, 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 blah. Powell said it would be premature to conclude that Fed had achieved sufficiently restrictive monetary stance. Okay, is this from today? December 1, yeah, this is assuming that this is Barron's, yeah, assuming so. Let's see, how does the market like this? You know, market 10 years down. So they're probably ignoring what Powell is saying, at least for now. So rates continue to deteriorate, that's good. So you do have a pretty big drop in rates, dollar drop, QQQ did rebound back. So I don't know what else he said, but people either choose to ignore what he's saying or choose to believe that, you know, calling his bluff, basically. Preferred inflation gradually starts to show inflation. Powell said uncertainty about the economic outlook is unusually elevated. He also noted the unwinding of higher pandemic era demand. I mean, I assume he said something else that people interpreted as bullish. I don't know what it is, but at least we know that as soon as he spoke, we drop pretty significant drop in rates. And that's something I would also watch, right? Assuming there's no signs of recession and yield continue to drop below this 4.3, right? The October highs of last year, that's at least resistant. If it continues to break through this level, that's bullish for the market, right? If there are no signs of recession, this would be bullish for the market. And that's probably why QQQ did rebound. All right, so that unknown is also kind of behind us. So then the next thing is unemployment data, right? Unemployment data. So people are still reacting positively to Powell, which is good. So now we need to look at the macroeconomic data and see which theme it's going to support, higher for longer, or Fed is going to lower interest rates the first 6 months. Well, it looks like he already spoke once today. James, how much does seasonality affect individual stocks over the overall market sentiment? I think individual stocks, sometimes they do, sometimes do not. Very hard to follow that personally. ETFs like energy, dollar, spiders, there are seasonal effects. So I would look at individual stocks and then look at which ETF it belongs, and then look at the seasonality. Like right now, one of very popular call, which I followed and was pretty successful, is to follow seasonality of silver and gold, right? Usually December is volatile, but then December, January, February, very bullish for silver, right? Silver usually, December it might pull back, but then it rallies, right? Then it continues to rally, and then very strong January, February, March. So if you look at the individual stocks that belong to that ETF, then you might assume that this January and February would be bullish for precious metals. So from that perspective, that's how I would look. And you see that it's not extremely overbought, right? It hasn't reached like April peak, and it's not rolling over. So there might be a little bit more room to the upside, right? Even though if you look at the, it's trying to break out of this downtrend, and I think it did, right? So it broke above this downtrend. It's facing July highs, and it's basically not that far away from this year high, which is 24. Let's confirm that. I think this year trading view is right. It's just, yeah, so 24, right? So assuming this level is taken out, then we could have an 2 to 4% rally in the silver. I don't usually make decisions based solely on seasonality. That would be a mistake, but it could be one of those input into your decision which can help you make a decision, right? And a lot of people right now for the entire market are following seasonality, including myself. And and that kind of at least since August, it's been working pretty well. Thank you, James. All right, 10:25. You guys are awesome. Thank you very much. I hope to see some of you at the closing bell or next week. Next week, Monday, Tuesday, there is no closing bell. I'm going to be traveling, so we're going to have a morning bell, but there will be no closing bell on Monday and Tuesday. All right, thank you very much. But today we will have a closing bell. So I'll see you at the closing bell, or I will actually see you on Thursday. Thank you.